Are there any clear bottlenecks that can be addressed? And then what is the overall size of the fiscal deficit? And so, yeah, I think there is merit to that. I think if, when you look at a country that's even further in fiscal dominance, like Japan, you get out is that structurally, trade deficits are part of how the current system works in the US. So they're not just like this thing that's kind of fixable on its own. It's part of a larger tapestry, which is...
The current economic landscape reflects a stark divide between asset owners and those struggling to enter the market. Rising interest rates have benefited those with existing fixed-rate mortgages, while younger buyers face an unaffordable housing market. Homeowners are reluctant to sell, keeping market activity low and reinforcing economic inequality. Lynn Alden highlights that fiscal policy, not just monetary policy, is the real driver of economic shifts. The Treasury is injecting $600 billion into the economy, creating significant liquidity waves that primarily benefit asset holders. Meanwhile, deficit spending continues to rise, funding programs like Medicare and Social Security, but also inflating interest expenses that favor higher income groups. The Federal Reserve's tools, primarily interest rate adjustments, are less effective in combating inflation in an environment dominated by fiscal expansion. While the Fed aims to slow bank lending, it cannot counteract the effects of monetized fiscal deficits, making its traditional strategies less impactful. Another key issue is the debt ceiling. If unresolved, it could force the Treasury to drain liquidity, influencing financial markets. Additionally, tariffs remain a wild card, potentially increasing government revenue, but also driving up consumer prices. As liquidity conditions tighten toward mid-year, the economy faces growing constraints. The Fed may halt quantitative tightening or shift its focus to Treasury purchases. In this environment, Bitcoin is emerging as a hedge against inflation and fiscal mismanagement. This period underscores a structural shift where fiscal policy rather than monetary adjustments dictates economic outcomes, shaping a K-shaped recovery that deepens wealth disparities. Like, subscribe, and turn on notifications. Support the channel by liking this video, subscribing, and enabling post notifications for more content on crypto and digital assets. Check out our other videos and share your thoughts in the comments below. Your engagement helps with the YouTube algorithm and keeps the content coming. Thanks for your support. Enjoy the video.
Which is decent liquidity conditions and ongoing fiscal dominance in the U.S., which is leading a lot of things to run hot, ranging from nominal GDP to asset prices. And a couple of the key things I'm watching for 2025 is basically anything that would change the course of that or give us some wiggles along that path. And so one of the things I'm watching first and foremost is the debt ceiling issue. Not because I expect much out of it in the long run in terms of all the defaults and stuff that can happen, but rather because when the debt ceiling's being contested, the Treasury has to do extraordinary measures, which they started this week, and that basically means that they have to drain cash from their account back into the system in order to keep paying their bills without issuing that new debt. So the longer that goes on, that's a liquidity factor, which can then translate into asset prices and other things like that, financial conditions broadly. And then also the one of the biggest things to watch is tariffs. That's potentially an all year thing to watch, but especially in the first few weeks and months here to see any sort of announcements around that. So I get a lot of questions around what's the Fed going to do. We obviously have an upcoming Fed meeting, but in this era of fiscal dominance, I pay a lot more attention to some of these other factors, even though, of course, Fed decisions still matter. The second half of the year, we're probably going to see liquidity constraints in the system.
Yeah, it sort of feels like regardless, a lot of these levers have already been pulled, and we're getting to the end of the road a little bit. You mentioned earlier in there about how Treasury Undersecretary Yellen has basically kept things afloat by prioritizing bills issuance over coupon issuance. So now we obviously have Scott Bessent coming in as the Treasury Secretary, and he's been a huge critic of that approach of prioritizing bills and weighing it. So he's come in here, and before he got nominated, he's been on the round circuits of podcasts, et cetera, and he's been talking about how we got to get to a point of a more sustainable fiscal path, and that includes prioritizing issuing on the longer end of bond yields, so more coupons. How do you think about that likelihood? Do you feel like that's something that's actually going to be happening, or once he gets in the chair and sees the risks that are posing, he relents and moves back towards bill issuance, or is he going to be steadfast? And what would that do to bond yields?
Well, so that's another big thing I'm watching. Is he going to follow through with his duration increase? If I imagine a scenario where he's successful in that, he could try to force it. And when those have to, and people are kind of waiting to buy and kind of constrained from buying, and so I think that's contributing to the kind of the K-shaped economy that we see right now. And now that I kind of view it as range bound. So during the rapid increase in interest rates, this was a really powerful effect that was happening. Now I think it's kind of absorbed. We've seen, banks have kind of absorbed a lot of the initial unrealized losses they had. We obviously some of the really problematic ones got cleared out, but now it's just kind of slowly being absorbed into bank capital. And then also I think the same thing's kind of happening on balance sheets around, which is that now it's kind of range bound, so it's less of a kind of a fast hitting factor and more of this background thing that's happening. And that's also why I categorize rate changes as so relatively inconsequential compared to other things, because one, it's fiscal dominance rather than monetary dominance. So whether or not you get extra several $100 billion in deficit spending or not is a much bigger impact than a few basis points. But then also the Fed cutting the short end doesn't necessarily translate to if we had gotten a Harris victory, then we would have had to more seriously consider some of those Trump era tax cuts expiring, going back into effect, which would have been effectively a tax increase. Now, because we get the Trump victory, those are less likely to be allowed to go back in. They're more likely to be either extended or made permanent in some fashion. And so that's basically all else being equal, a deficit contributor. But then on the other hand, now we have to seriously consider tariffs to some degree. And those are tricky because to what extent are they taxes on the American people versus taxes on foreign businesses? The proponents of tariffs would like to say that it's going to come out of the profit margins of the foreign producer. But a lot of, especially physical goods, a lot of profit margins are 10, 20, 30%. So if you put 20% tariffs on someone, they're either going to not sell to that market or they're probably going to increase prices to some degree. And so we could see additional revenue from I believe they call it the external revenue service. So that could balance it out on that. But if the dollar was cut to zero, the Brazilian central bank could probably ease, and that'd probably give a little bit of a boom in Brazil, which would then compete for things like oil and commodities and probably give us some inflationary pressures. So the part where I would agree with him is that interest rates are not the strongest lever to control inflation when you have fiscal dominance, because you raising rates does slow down bank lending a little bit, but also blows out the fiscal deficit by literally a bigger number. And so it's kind of a mixed bag. And so I'm kind of neutral on that whole thing. The biggest levers for inflation and this whole thing is energy abundant. Is trade flowing well? Are there any clear bottlenecks that can be addressed? And then what is the overall size of the fiscal deficit? And so, I think there is merit to that. I think if, when you look at a country that's even further in fiscal dominance, like Japan, you can get to an argument where interest rate increases are actually pro-inflationary directly. But because the U.S. is kind of teetering on fiscal dominance, interest rate increases probably have a somewhat neutral effect, which is to say that you do slow down bank lending, could be erring toward tightness. And one of the interesting factors is if we do start increasing our export capacity, our natural gas prices could increase. So right now, oil is pretty fungible. It's relatively low cost to transport it around, whereas natural gas has a lot of limits for transporting it, given you either need a pipeline or you need expensive LNG export facilities and pipelines to bring it to them. And as we increase our export potential, we could see a normalization where North American gas prices go up and then bring down gas prices to the places that we are exporting it to, which currently have much higher prices, which can't really be arbitraged because of that limited throughput in terms of exporting. So I don't really see energy-driven inflation as a key risk the next, call it, 2 years, unless there's some sort of major kinetic book of the U.S., which is that they're pretty reticent to do fiscal, um, and instead they're doing a lot of kind of monetary dovishness, which then translates to more currency strength on the dollar on a relative basis. We also have Europe kind of slowly melting, like in terms of economy and tech. They've lost a lot of their energy security. They don't really have the tech. We've seen gradual deindustrialization in Germany, and that's a really big component of the dollar index. So when I look at kind of dollar wrecking ball, I'm looking at mainly like other currency pairs outside of the euro. So dollar to Chinese currency, dollar to Brazilian currency, and those are kind of levels that I'm watching. And one of the things I kind of pointed out is that structurally, trade deficits are part of how the current system works in the U.S. So they're not just like this thing that's kind of fixable on its own. It's part of a larger tapestry, which is now any sort of decisions around strategic Bitcoin reserve are probably separately considered than trade for the most part. And so, while that could be certainly beneficial, it's certainly beneficial for Bitcoin price. And if I was advising any entity, whether it's a corporation, whether it's a family, whether it's a country, it'd be like, yeah, you probably should have some Bitcoin. If your goal is to maximize whatever thing that you're running, owning more Bitcoin is probably going to benefit you in the long run. So we'll see how that goes. If we look out long enough, then things like Bitcoin and having a Bitcoin reserve can actually affect some of these trade dynamics, because one of these solutions to having a structurally overvalued dollar and therefore a structural U.S. trade deficit is to instead have more international contracts and more international reserve stored in neutral reserve assets. There's basically two methods. One is you either have a more multipolar currency world, so you say, okay, so now the potential risks to global liquidity are tariffs or anything that would spike the dollar, but that's offset by the fact that we have a president that generally wants higher asset prices, that would generally not want a super strong dollar because he would perceive it as going against his trade policies, and you would potentially even label certain other countries as currency manipulators if they let their currency weaken too much relative to the dollar. So these with some bumps in the road, I expect decent liquidity this year, which probably is supportive of Bitcoin and gold. And then I also look at things like kind of Bitcoin's own metrics. So when I look at, say, market value compared to on-chain cost basis, so market value versus realized value, I like to look at those types of ratios to see kind of how euphoric is the network. And so far, it looks nothing like prior major multi-year tops. It looks kind of middling in the road in terms of that metric. Similarly, when I look at, whenever there's a major bull run, there's like the HODL wave. So what percent